Hi, ReAnn Gonzalez with Edge Home Finance here in El Paso. If you're a realtor working with self-employed buyers or you're a 1099 buyer working on your 2025 taxes right now, this is the conversation that can save a deal in 2026 or 2027. Because what you file on your taxes can directly change what you can qualify for. Okay, so now let's get into it. Let me say this clearly because it surprises people every week. When you're self-employed, we don't qualify you off of what you made before expenses. We qualify you off of what your tax returns show as net income. For a sole proprietor, that's typically your Schedule C net profit. For an LLC or corporation, we may be using K-1 income and in some cases the business returns too, depending on how you're set up. Now, yes, we can add back a few items that don't hit your real cash flow the same way, like depreciation and sometimes certain documented one-time or non-cash expenses. But the foundation is still the net. So when someone tells me, ReAnn, I make $200,000 a year, but their taxes show $45,000 net after write-offs, I have to use what's on paper. That's the number underwriting works with. I'm not judging your write-offs. I get it. You're running a business. I'm just telling you how mortgage rules work. Realtors, this is why your self-employed buyers should talk to the lender before they file taxes, not after. Because once those returns are filed, we can't explain our way around a low net income. We either qualify with what's filed or we pivot to a program designed for self-employed borrowers. And I'd rather plan it the right way up front than scramble later and lose a home over paperwork. Now, here's the good news. If your net income is too low for a traditional conforming conventional loan, we may have an alternate option, like a bank statement loan. With a bank statement loan, we typically qualify you using your last 12 to 24 months of business or personal bank statements, depending on the program. You generally need to be at least a 25% owner of the business. So, what are the pros? Number one, you may be able to qualify for a higher price point even if your tax returns don't show strong net income. Number two, no tax returns required in many cases. Number three, less documentation than a traditional self-employed file. And what are the cons? And I'll keep it real. Higher down payment, commonly 10% minimum, compared to conforming options like 3% down for some first-time homebuyers or 5% down for others. Interest rate is usually higher also than conforming. Let's do a simple comparison with a $300,000 purchase price. Scenario A will be a conforming loan and your rate is lower on a traditional conforming loan. Scenario B will be a bank statement loan, and let's say the rate is higher by about 1.25%. If you put 10% down on the $300,000 home, your loan amount is $270,000. On that loan amount, a 1.25% higher rate can cost roughly about $3,400 more interest over the first year. That's a ballpark, but it's close. Now here's the key question. If you try to force your tax return net income higher just to qualify conventional, what's the IRS cost? If you increased your net income by, say, $50,000 to qualify, your additional taxes could easily be $12,000 to $18,000, depending on your bracket and self-employment tax situation. So let's compare. Extra interest for 1 year with that higher rate, around $3,400, or an extra tax bill to the IRS to show higher income, potentially $12,000 to $18,000. That's why I tell clients, don't make tax decisions blindly just to qualify for a mortgage. There may be a smarter path. If you're self-employed and want to buy in 2026 or 2027, here's the old school advice that still wins every time. Call me before you file. Keep your bank statements clean and consistent. Separate business and personal accounts. Don't take on new debt or big equipment payments right before qualifying. If you're a realtor, connect your buyer with me early so we can map out the cleanest route to approval. I'm ReAnn Gonzalez with Edge Home Finance. My job is to give you straight answers, clear options, and a plan that gets you to the closing table. Realtors, if you've got a self-employed buyer thinking about 2026 or 2027, send them my way now, before tax filing locks us in. And self-employed friends, if you want to buy soon, let's talk strategy first, not regret later.